Now, in capital budgeting, we're going to look at the different cash flows for a fictional project, a very simplified one. So this will cost, they're looking at going into the energy drink business, and you're going to evaluate it. The energy drink will be produced in an unused building next to their College Park plant. Now, they own the building. It's fully depreciated, so we don't have to worry about cash flows from that. The equipment's going to cost $200,000 plus an additional $40,000 for shipping and installation, and the unused building could not be rented out for anything else. In addition, inventories would rise by $25,000, while accounts payable were increased by $5,000. This will increase our net working capital by $20,000. All of these costs occur at time zero. Now, by special ruling, we're going to be able to depreciate this under the maker's depreciation system. Economic life of 4 years. We're going to sell the machine at the end of the project life for $25,000. Now, some textbooks may say depreciate down to salvage value. No. We depreciate down to zero, not to salvage value. This is not a salvage value. It's just a price for selling the used machine. It's a 3-year maker's class. Continuation. We're going to just assume that sales are always 100,000 units at a sales price right now of $2 a unit, and therefore sales are going to go up due to this machine by $200,000 each year. Unit costs are 60% of the sales price, or $120,000 a year, and our net operating working capital, we said, will go up by $20,000 a year. Our tax rate 40%, project cost of capital 10%. The cash inflows begin at year 1, not year 0, like the textbook has sometimes said for the makers. We're not having any relevant revenues, and we're not putting the machine into use until year 1. So a little bit different from the textbook. And we're going to assume that this project is of equal risk to their other assets, and we're going to decide whether to accept or reject. So we need to look at a number of procedures and questions and analyze. So we found what's our investments in year 0, the increase in net working capital, an increase in inventories that is partially funded by an increase in payables. So therefore, our net working capital will go up by $20,000 in year 0. Our equipment's cost is $200,000, but also our installation's relevant, and it's significantly relevant that we will depreciate both the cost and the shipping and installation. We do not depreciate the change in net working capital. So we have here at year 0 cash flows going out of $260,000. We're depreciating $240,000. So what is our depreciation expense each year? $79,992 in year 1, $106.68 year 2, $35.54 year 3, $17.78 year 4. Makers has what's known as a half-year or mid-year convention. A 3-year asset is depreciated over 4 calendar years. So it's sort of said no matter when you buy the asset, January 1st, December 31st, or any place in between, assume you put it into use on July 1st of the first year. So therefore, you depreciate over 36 months, but over 4 calendar years. And as I mentioned before, the textbook assumes you begin usage in year 0, but in this simple example, usage begins in year 1. So here are our operating cash flows. Revenues, all the same. Operating costs, all the same. Depreciation expense, you can see, is different. So our earnings before interest and taxes is different. Now notice that our operating income, our unlevered net income, is negative in year 2. Our operating income is also negative. I am making an assumption that we have taxable revenue from other lines of business so that we can get a reduction in our corporate income tax in year 2 due to the operating loss on this project, which is primarily due to the effect of the maker's depreciation substantially increasing depreciation expense in year 2. So we get our operating income, which is our unlevered net income, add back our depreciation expense, and that gives us our operating cash flows. Now you may have noticed there is an Excel link here. If you click on the Excel link, it will bring up the relevant operating cash flows here. So they're here for you to look at and see how everything was calculated. You can see the calculation of the depreciation expense, B6, which is the capital expenditure, times C5 here, the depreciation percentage for year 1. Now, we also have relevant cash flows. We've talked about year 0. We've talked about the operating cash flows. We also have some end-of-life cash flows. We said that we can sell the used machine for $25,000. Now we're in the 40% tax bracket. That is completely a gain. We had depreciated down to 0. So there will be a tax on our gain, and our net terminal cash flow is $15,000 from selling the machine after subtracting our tax. And again, if you click on this link, you will see here the terminal cash flows. Now there's another relevant terminal cash flow, and that is the recovery of the net working capital. So you might say, how is it recovered? It's not really recovered, but remember what I said earlier. Cash outlay when you purchased the beginning inventory was relevant. At the end of the machine life, you're using the inventory that's already there. The cost of goods sold overstated the cash flow in the last year of the project, and so we say we recover this net working capital. Now, there is a tax on the sales proceeds if we have depreciated down to below the amount that we sell it for. If we have a gain on the sale, then we have a tax. If we abandon it or we sell it for less than the remaining book value, we might be able to even get a tax refund. So we'll look at a side note if we terminate the project before it is fully depreciated. But next, let's look at how do we decide whether or not to take this project, calculate the net present value.